in listen-only mode.
Hey everybody, Preston Bryn here with our trader user group Wkly Round-Up. This is for the trading week ending July 21st, 2017. What I've got on the screen here is a weekly chart of the S&P 500 E-mini futures. Before I jump into it, however, we've seen global markets everywhere from Europe, Asia Pacific, even in the US moving higher. We've seen the US dollar moving lower, euro getting much stronger, which we had talked about. Bonds moving up, interest rates coming down, inflation staying lower than most central banks really understand. And obviously, with all of this, we've seen the VIX. The VIX closed at 9.30, 9:30 this past Friday. Or the low, it had a low intraday print of 9:30. Still extremely low, decades low. We did have one print below 9 in a few years ago, but we're still very low in the VIX. We've seen core inflation, just looking at the data this past week, only growing about, excuse me, about 60 basis points or 0.6%. And as a FYI, that's the slowest rate of growth since 2004. And this, by the way, is also a global story. It's not just in the U.S. Inflation is low everywhere. And I've read all these reasons. Everybody, the human condition is naturally prone to try and find a reason for everything. If you watch the TV talking heads, they'll come out and tell you exactly what the reason why the market did what it did after the fact. I mean, that's always easy to do, and 9 times out of 10, they're always wrong. But at least some of the things that we're getting for the reasons for low inflation is excess debt um, by governments taking on. Automation is a good one with robotics causing, even though we've got very low unemployment in the U.S., unemployment is coming down in Europe as well. It's still much higher, but it's still coming down. But we're getting automation, so people are willing to forego wage increases for fear of being replaced. I've heard the Amazon effect, reducing costs across many different industry segments. In fact, Amazon just announced with Sears jointly that they're going to sell the Sears Kenmore appliances via Amazon. And within one day, that wiped $11.1 billion off the market cap of Home Depot and Lowe's as a challenge to some of the things that they're doing. So you can see the Amazon effect and what it does to other industries, primarily the retail, but it can go into the food services when they announce the potential acquisition of Whole Foods and other grocers just really taking it hard market cap wise in the markets. So we're seeing a lot of this low inflation. In fact, Janet Yellen, who we finally call AKA Aunt B, she really is kind of a little bit of a conundrum as well, not really fully understanding the low inflation. But speaking of Aunt B, we got the FOMC coming up next week, Tuesday and Wednesday. Wednesday's their policy statement. No one expects them to raise rates. However, everybody wants to see what her BS is going to be. And when I say BS, balance sheet is what I'm referring to. Balance sheet reduction. 4.5 trillion on the balance sheet. And because we've never had this much before, it's really hard to guess, how the intermediate and long end of the yield curve is going to react. That would be the 10-year, 30-year bonds. Really hard to see how things are going to react. But anyway, the markets want to see what she's going to have to say to that. And one other final note, and we'll take a look at the charts here. Q2 earnings, we've had about just slightly under 100 companies report already. And we've had 74% of them beat the bottom line number. Now, the bottom line is a number that you can engineer. You can buy back stock. You can do a number of things to increase your earnings per share. I always say the top line is the hardest one to beat because it's sales. You either have sales or you don't. But we're seeing in this Q2 earnings, 72% of the companies that have reported have beat their top line number. That is a great thing, folks. Really strong. And we're beating bottom line and top line. In fact, the forecast for Q2 growth is about 10%. Now, that's a little bit less than Q1 growth, but nonetheless, it's still very strong. And it's also being helped by a very low dollar. Starting almost the first day of 2017, the dollar has been moving lower against the euro. And I've said here, hopefully you've been able to take advantage of some of these things where you want to be long the euro dollar or long the euro short the dollar, because I saw the euro going up over 113, 114. Now it's even surpassed my estimate. It's up, we have, 30-month highs for the euro. And they say that for about every, when I say they, analysts have they put in their mathematical models, they say for about an every 2% reduction in the US dollar, it grows earnings, US corporate earnings, about 1%, because the bulk of S&P earnings are offshore, about 55, 57%. The Dow is even more. But the Russell is mostly US based, or not as a larger percentage. But we could see some sector rotation back into small and mid cap, which we're starting to see, because the Russell was trailing everybody. And now it's moved up stronger, and that could be a good sign. Now, I kind of laugh when I see other folks out there talking about going short. We got to be short. We got to be short because we haven't had a pullback, a 5% pullback in over a year. So we've got to be short. It would be ready for shorts. And I've got friends that have been in the industry for a long time that can't understand this long run higher. And it is a little bit perplexing, but the price action says you got to be long right now. If you're not, you're just sitting on the sidelines. And then when you finally capitulate and get long, that's probably when the market's going to roll over. Um, we've taken advantage of some of these. There are a number of things that we do in our secret trader that, for those of you that are not members of our group, you should think about, because we have what we call anchor trades where we don't really care where the markets go. We, through the adjustment and the power of options, we manage the Greeks and the deltas and the gammas of the trade. Manage the gammas, you manage the deltas indirectly. But we basically play the markets with a big anchor sitting out there that, actually, if it pulls back, we actually make a little bit even more money. But as long as the markets move higher, hey, we'll partake and we'll take advantage of it. And then we also have some directional trades, and we're also playing options in the futures market as well. And we're on the 14th trade. We've had 13 in a row, successful trades. We're usually in and out of these in less than a week to 10 days. And we've been successful in them, and we're going to be adding to these too. So these are just a number of things that we're doing. One of the things that I've been asked, because I survey my members every year, and one of the things that, and just working with my members that we do, is they'd like me to start a couple of different size portfolios. So if you've got 5 to 10K, you can play in some of the trades that we do. And if you've got, under 50K, you can play in some trades. And then if you got over 100K in a portfolio margin account, we have trades set up just for those. So there's a number of different ways to play with us if you want to. We're having a fun time this year. But when the markets go up, even people that just throw darts at the wall can make money. But I think the proof is going to come in the pudding in the next 6 months to next year. I'm on record as saying that the markets are getting perilously high, and we can experience a jolt. And in fact, big money players, their biggest fear right now is a bond debacle. Thinking that the bond market could be the first thing that could come unglued when they start to reduce, when Janet Yellen gives us her BS strategy. That would be balance sheet strategy. In reducing the balance sheet, any missteps, I mean, they're literally walking on the wire here, and we've never been here before. That could set off a global contagion in the bond market. Move that down, and then you'd see equities fire off to the downside. So there's a number of different geopolitical risk out there. Fiscal risk, policy risk, geopolitical with North Korea, and all that kind of stuff. So that's what we've got going on right now. If we look at the markets here, what you'll see on the screen, I've got a weekly chart of the S&P 500 E-mini futures on here. Okay, and looking at it, you can see this is and again, it goes all the way back to the lows back here when we started the year in 2016. And we literally went into an official correction very quickly, and it moved. We started January right here, and then we just went flat down, right? And then I was getting our members long somewhere right in this area here. And then we just, we had a good year for 2016. Now going into the election, you can see right in that area here going into the Trump election, you can see right there was the low in overnight election for Donald Trump. And you could see the markets were selling off. And then when Trump won, I think it surprised a lot of people. And the idea of reflation, stimulus coming back, he was going to put a lot of money into infrastructure. He was going to cut taxes. He was going to reduce regulation. He was going to repatriate money and allow corporations to move money from Europe back over to the U.S. at low tax cost basis. That money was going to be reinvested in plant and equipment and all these other things. And then there was health care, and they were going to take the taxes out of Obamacare. And you get the story, right? And not one thing has happened. Yet we've moved from the lows all the way up here to all-time highs. Okay. Now, what's caused that? A lot of people think that this is a bet on the come of what Trump is going to do. And probably some of it is from half-truths and probably correct. U.S. Congress is on record as saying they want to get some tax cuts in this year as well. We'll see what happens. But rather than trying to play the guessing game, we have been long. In fact, in overnight session, we were up at 2 in the morning on the Trump election, and we put in buy orders in the futures market for the Dow futures at about 15,750 or 17,750, and that sucker has just paid off big time in the futures market. It's $5 a point. And we've moved up quite a many points, and that's per futures contract. But you can also see I've got these channel here. This channel, when you look at it, forget the word channel for a minute. What I want you to focus on is just the fact this is the upward vector of the movement of the market. And as you can see, as I draw that line up here, it has not changed. It has been really off of the 2016 lows, that slight dip right here going into the Trump election. And then when he won, we've resumed this upward vector. And that is all on the premise that, partly what Trump has said or his administration wants to do, but it's also a global story inserted in here as well. So what can cause this thing to come unglued? As I said, the biggest fear is the bond market. I'll take a look at the charts here in a minute and show you what I'm talking about. But if the bonds roll over, it's going to cause some issues everywhere else. And what would set that in place? That would be Janet Yellen's BS story, her balance sheet. What is the balance sheet reduction? Right now, the market's put about a 39% chance at a rate hike between now and the end of the year. Okay, now Yellen is on record as saying we're going to hike again. Typically, they only hike 4 times a year because she can do her press conference. That would be September. So this meeting, next week coming up on Wednesday, no one expects the rate hike, but they do want to hear what her BS story is. And I want to hear it as well. And you're going to see it probably in the bond market. You're going to see the markets react. So this is the upward vector that we've got right now. It is still intact. And the markets just do not want to give it up. And at this point in time with strong earnings, there's no reason to. Now, I've always said there's only 2 things that drive the price of the markets, just 2 things. And earnings per share is one of them, and interest rate is the other. And it's all a matter of where money goes, because nowadays with technology the way it is, big money can move from country to country, from asset class to asset class, from debt instrument to equity, equity to debt to currency, very, very easily. And money flows where it can get the best return for the lowest risk, big money. And that in turn trickles down and affects equity markets. Now, earnings play a big role in that. And PE ratios, price to earnings ratios are driven by interest rates. And interest rates, the higher they go, the more debt starts to compete with equity for where money will go. Right now, there's been no competition. Debt has been driven interest rates extremely low. So the only place where money can find yield is in equity. And that's why we've had this really huge move. And the lower interest rates stay, or let me say it another way, the longer interest rates stay low, the more it's going to drive equity higher. And it's going to make it harder and harder when interest rates do start to go up, or this BS reduction starts, It's going to make it harder and harder for equity to compete, and it could cause a crimp. That's the biggest worry that big fund managers have right now. Okay, in this thing, and I would agree with them. It's an existential threat to the market. So looking at this, you can see here the blue line is volume over price on the left-hand side of the screen, and you can see that the 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 massive amount of buying that came in once Trump won. And the S&P was at 2028. We're at 2476 roughly right now, right? I mean, the E-minis closed at 2470, just 6 points off their all-time high. But we were down at 2028, and then we've had this massive move to the upside, all on the idea of what he's going to do or could do. And there has been a bump because of corporate earnings here, as I've said. Now, if we shake it down and let's take it into the daily chart here, we'll zoom in a little bit. You can see the vector. You can see each of these S1, S2, these are support level 1, 2, and 3, and so forth. You can see we're at these all-time highs. You can see very little divergence here in the indicators down below. It really just it totally amazes me. And you can look at the RSI and you can see there's a little bit of a divergence setting up here, which would suggest as we round out earnings, then we're going to be in a soft patch for the markets probably into the August month going into September. But remember, momentum is hard to stop once it starts. But we've got a nice little support area here, right around 2416 down to 2400. You can see the volume over price right here. So there's some supply down here. People want to buy. You can see the upward vector both in this red line, which is the 50 EMA and the 200 EMA. So we've got a number of things that are playing in this market to keep it bullish. I've told our members that any pullback is a buy on the dip kind of opportunity. Now, if we look at the Russell, which was bringing up the rear, as I said, and now you can see here that the Russell just all of a sudden, it just started moving strong up and made new all-time highs right here at 1445.40, and we're near the all-time high. So it has been the Russell has been in a tight range, right? I mean, if you look at it, it's been in this tight range for a little bit of time here. And then as we moved out of it, it is trying to get back. It's trying to get some velocity up here, but I just don't know if it can escape, has enough energy to get escape velocity on this thing. So that's a little bit about what we're looking at here. And as I said, in volatility, if we look at the VIX, which is just totally amazing to me, we got down here the VIX. It closed the day at 936 on Friday, right? And if we look at this, you can see the 2017 low was actually printed on Friday at 930. Now that 860 low was made a little bit earlier, but I mean, this is just tremendous for me. I mean, when you got low vol like this, it changes some of the strategies that we do with options, because traditionally selling options, doing credit spreads and things like this are a great way to collect money on a market that is going range bound. It's trading a range bound market to slightly higher. But when you have volatility this low, then you've got to be more a buyer of options than a seller. And there are a number of strategies that we talk about where you can buy options and profit from the going long some of these strategies where you're long vega or volatility. So this is kind of what I'm looking at here, but also notice on this chart that down at this level here, you have these spikes, and these spikes are very difficult to predict. And you can see going all the way back a few months till March, really, the spikes only last a few days, and then they give it back up again. So we've got to watch this very carefully, but this basically tells me that we're due for a little bit of a spike in volatility. So that's a little bit about what I'm seeing there in the vol market. And then, of course, if we come down here and we look at the treasuries and bonds, this is where the existential risk can come from right here. You can see in the bond market where now we've played the bond market and had a lot of success playing this down move right here. We've got this move here that looks like a counter move in the overall bond market. You can see we completed an Elliott wave 5 to the top. We've moved down. This is a very bearish move right here, and we played it nicely for our members in our secret trader. But you can see we're getting this counter trend rally here. Now we've taken out the 50 EMA and we're testing the 200 EMA right here. If we take this out and we start to get some more escape velocity from this wider support zone right here, where you can see this volume over price, then we could get a nice run back up, which would then suggest that the equity markets are pulling back a little bit. It would not surprise me. Now we're setting ourselves up because remember, next Wednesday we get Janet Yellen's BS strategy. They're not going to raise the rates, but what we will see is some movement in the US dollar and the bond market. And that's going to cause movement in currencies worldwide based on her BS statement. Okay, and that's what people want to see. They want to see this, and they want to see exactly what her BS statement is going to be. Okay, so do I, and it's going to move the markets. I believe she is going to be put in a position where they're already on record as saying starting September they're going to reduce the 4.5 trillion US balance sheet. That's going to have a tendency to move the bond market lower and interest rates higher, right? That is going to be the tendency. So let's watch this thing and see how this thing plays itself out. Now, if we come over here and look at currencies, you can see the US dollar. And this was one that I've been talking about quite some time. And you can see this channel that it's been in. And this channel really started right at the beginning of January of the year. If I just back it out, you can see the high print here. Right here is on January 3rd. And we've been working our way down ever since. And we actually broke out below the bottom of the channel. That is just so bearish. Any counter trend move here is still probably going to be sold into. And by the same token, if we look at the euro, you can see the euro is just screaming higher. I mean, up to 117.18. Now, I don't like that because I spend 2 or 3 months in the summer over in Europe doing seminars and meeting with clients and doing things like that. But you look at this and it's amazing. Now this, I think any kind of pullback here is going to be met by buyers and they're just going to drive this higher. Why? Because Europe has been the place to be in the second half of this year. I've been talking about it for about 90 days now. And I've been saying when the euro is down here, and I called the euro to get down around 102, 103, and it actually came down to 105. So I was fairly close. But then once we started getting Draghi throwing out comments, Super Mario on the ECB on their stimulus, you can just see here that we've just steadily moved higher and higher with the euro. Okay, and that I don't think that's going to change anytime soon. If we look at the British pound, now the British pound is a different one. It's a different animal. They've got the Brexit to worry about. It did move down below 130, came back up, and now we're sitting here. We closed the day at 130.17. It's going to be very choppy, but I have always said the British pound about 2 years from now is going to be back at least 135 to 140. I think it's a good play, but it's very difficult to hold on to it. So, some swing trade plays make sense here. If we look at gold, the gold is one of those kind of assets that I was bearish on, and you can see this, we started 2017 at 1151 in gold. And we've had a very choppy move to the upside. We broke the upside channel, and then we came down, and now we're trying to get this bounce here. I am still not convinced that this bounce is anything more than a counter trend bounce. If Yellen comes out and is a little bit more hawkish in her views, you're going to see gold roll right back over, come back down to this area where I said it's probably going to rest for a bit, which is around the 1200 area. I had projected around 1200 and it came down to 1204, and now we're getting the typical counter trend move here. If we can get enough escape velocity or energy to give us escape velocity over the 50 and the 200 EMA, I believe it's going to go higher. But for now, I think it's going to hold up here. At least the charts would indicate be careful at this level. Do not chase it. And that's not what I'm going to do. Let's look at oil. Oil really, if we back off just a little bit and look at the 2017 high, right? I mean, if we look at the 2017 high, what's it at? 55.24. Okay. And we're down to what right now? Where did oil close the day? Oil futures at 45.60, right? So we're looking at $9.64 off of the 55.24 area there. You know, and it is a pretty good little pullback, right? It, it represents a. Well, let me just do this. Let me do the math here and see what it is. So about 9.6. I could figure it out on the chart, but I don't want to do it that way. So it represents about a 17% pullback from the highs in 2017. Now, I know the oil market really isn't a bear market because it's down off more than 20%, but I'm just talking about for 2017. We're down over 17%. You can see this. I believe it's, and I was saying it was a counter trend rally. We have a 3-leg and then a possible 4-leg. You have typically a 3-4-5 pattern, although I'm not really sure that this would be that. You can see I've got a lot of support down here around the 39 barrel area. With oil, we've got OPEC up to their shenanigans again. They're over in Russia, both OPEC and non-OPEC producing oil countries meeting in Russia this weekend, going into Monday and then Tuesday, and then we'll get there. They'll come down and give us their crap on what they're going to do. Are they going to be able to curtail production even more, or are they going to keep it as is and bring Nigeria and Libya into the group? Who knows? But we could see a little bit of chop here, but we've been playing oil range bound here now since Q4 of last year, and we've been working it out very nicely. It's been very choppy, as you can see, but I think overall a wider range is kind of where oil is still going to stay right now. A lot of activity in the agricultural market. There have been some really great moves in the soft market where we've scored home runs and grand slams actually in the sugar market and in the um, orange juice market. But that's where we're sitting right now, folks. I just wanted to give you guys a quick update. If you're not a member of our group, I highly encourage you to come in and check us out. Otherwise, make it a great weekend. And members, I will see you tomorrow night for our weekly market watch, Sunday night at 8 p.m. Eastern Standard Time. Take care, everybody, and I'll be in touch. Ciao, folks.